Hello everybody, I'd like to welcome you on our third educational webinar. The webinar name is How to Trade Candlestick Pattern in Forex. But before we start the webinar, let me ask you to confirm that you can hear me properly and you can see my screen. So if you can see my screen and you can hear me, type yes in the question section. Put a plus sign or simply type Y. All right, I see several confirmations. Once again, those of you who didn't confirm that you can hear me properly and you can see my screen, please type yes, Y, or put a plus sign in the question section. All right, the majority of you have confirmed that you can see my screen and you hear me. Once again, I'd like to welcome you on our third educational webinar. The webinar name is How to Trade Candlestick Patterns in Forex. My name is Yuri Safrono. I'm an A2ZMarkets.com chief currency strategist and a person behind the daily free Forex signals on A2ZMarkets.com. I have a PhD degree in finance and I work as an independent equity manager. I have extensive experience in trading stocks, crypto, and Forex since 2009. First of all, I'd like to tell you that this webinar is sponsored by Forex4you, and let me briefly introduce you to the company. eGlobal offers two main services: online trading on more than 150 instruments under the brand name of Forex4you, and copy trading investing services under the brand name Share4you. Before we start the webinar, let me briefly mention the disclaimer. Any opinions made may be personal to the author and may not reflect the opinions of Forex4you. All expressions of opinions are subject to change without notice. This material is considered a marketing communication and does not contain nor should not be construed as containing investment advice or an investment recommendation or an offer or solicitation for any transaction in financial instruments. Forex4you makes no representation and assumes no liability as to the accuracy or completeness of the information provided, nor any loss arising from any investment based on a recommendation, forecast, or other information supplied by an employee of Forex4you, a third party, or otherwise. Okay? All right. That's the right time to start the educational part of the webinar. Before we start, let's do a short history introduction. In the 18th century, a Japanese man named Homa, a trader in futures market, discovered that although there was a link between price and supply and demand of rice, the markets were strongly influenced by the emotions of the traders. He understood that when emotions played into the equation, a vast difference between the value and the price of the rice occurred. This difference between the value of the price is applicable to stocks today as it was to rice in Japan centuries ago. The principles established by Homa and are the basis of the candlestick chart analysis, which is used to measure market emotions surrounding a stock. This charting technique has become very popular among traders. Candlestick charting is a very complex and sometimes difficult system to understand. Here we get things started by looking at what a candlestick pattern is and what it can tell you about a trading instrument. In order to create a candlestick chart, you must have a data set that contains open, high, low, and close values for each time period you want to display. The hollow or filled portion of the candlestick is called the body. also referred to as the real body. The long thin lines above and below the body represent the high, low range and occult shadows, also referred to as wicks or tails. The high is marked by the top of the upper shadow and the low by the bottom of the lower shadow. If a trading instrument closes higher than its opening price, a hollow candlestick is drawn, with the bottom of the body representing the opening price and the top of the body representing the closing price. Okay, on the right you can see such a candle. So if a stock or a currency pair closes lower than the opening price, a filled candlestick is drawn with the top of the body representing the opening price and the bottom of the body representing the closing price. Compared to traditional bar charts, many traders consider candlestick charts more visually appealing and easier to interpret. Each candlestick provides an easy-to-decipher picture of price action. Immediately, a trader can compare the relationship between the open and close as well as high and low. The relationship between the open and close is considered vital information and forms the essence of candlesticks. Hollow candlesticks where the close is greater than open indicate buying pressure. You can see it on the left. And filled candlesticks where the close is less than open indicate a selling pressure on the right. Generally speaking, the longer the body is, the more intense the buying or selling pressure. Conversely, short candlesticks indicate little price movement and represent consolidation. Long white candlesticks show strong buying pressure. The longer the white candlestick is, the further the close is above the open. This indicates that price advanced significantly from the open to close, and buyers were aggressive. While long white candlesticks are generally bullish, much depends on their position within the broader technical picture. After extended declines, long white candlesticks can mark a potential turning point or support level. If buying gets too aggressive after a long advance, it can lead to excessive bullishness. Long black candlesticks show strong selling pressure. The longer the black candlestick is, the further the close is below the open. This indicates that prices declined significantly from the open and sellers were aggressive. After a long advance, a long black candlestick can foreshadow a turning point or mark a future resistance level. After a long decline, a long black candlestick can indicate panic or even capitulation. On the next slide, you can see a Maribozo brothers. Those have even the longer candlesticks, black and white. Maribozo do not have upper or lower shadows, and the high and low are represented by the open or close. A white Maribozo forms when the open equals the low and the close equals the high. This indicates that buyers control the price action from the first trade to the last trade. Black Maribozo form when the open equals the high and the close equals the low. This indicates that sellers control the price action from the first trade to the last trade. The upper and lower shadows on candlesticks can provide valuable information about the trading session. Upper shadows represent the session high and lower shadows the session low. Candlesticks with short shadows indicate that most of the trading action was confined near the open and close. Candlesticks with long shadows show that prices extend well past the open and close. Candlesticks with a long upper shadow and short lower shadows indicate that buyers dominated during the session and beat prices higher. However, sellers later forced prices down from their highs, and the weak close created a long upper shadow. Conversely, candlesticks with long lower shadows and short upper shadows indicate that sellers dominated during the session and drove prices lower. However, buyers later resurfaced to beat prices higher by the end of the session, and the strong close created a long lower shadow. Candlesticks with long upper shadows, long lower shadows, and small real body are called spinning tops. One long shadow represents a reversal of sorts. Spinning tops represent indecision. The small real body, whether hollow or filled, show little movement from open to close, and the shadows indicate that both bulls and bears were active during the session. Even though the session opened and closed with little change, prices moved significantly higher and lower in the meantime. Neither buyers nor sellers could gain the upper hand, and the result for a standoff. After a long advance or a long white candlestick, a spinning top indicates weakness among the bulls and a potential change or interruption in trend. After a long decline, a long black candlestick, a spinning top indicates weakness among the bears and a potential change or interruption in trend. The next slide shows you the well-known, and I believe you have heard it multiple times, a doji candle. A doji are important candlesticks that provide information on their own and as components of a number of important patterns. Doji form when a securities or a currency pair open and close are virtually equal. The length of the upper and lower shadows can vary, and the resulting candlestick look like a cross, inverted cross, or plus sign. Along doji are neutral patterns. Any bullish or bearish bias is based on preceding price action and future confirmation. The word doji refers to both singular and plural form. Ideally, but not necessarily, the open and close should be equal. While a doji with an equal open and close would be considered more robust, it's more important to capture the essence of a candlestick. Doji convey a sense of indecision or tug of war between buyers and sellers. Prices move above and below the opening level during the session, but close at or near the opening level. The result is a standoff. Neither bulls nor bears were able to gain control, and a turning point could be developing. So how should we use dojis? This example will show you how to use dojis with trend. And the relevance of doji depends on the preceding trend or preceding candlestick. After an advance, a long white candlestick, a doji signals that the buying pressure is starting to weaken. After a decline or a long black candlestick, a doji signals that the selling pressure is starting to diminish. Doji indicate that the forces of supply and demand are becoming more evenly matching, and the change in trend may be near. Doji alone are not enough to mark a reversal, and further confirmation may not be warranted. After an advance, a long white candlestick, a doji signals that buying pressure may be diminishing, and an uptrend could be nearing an end. Whereas a security can decline simply from a lack of buyers, continued buying pressure is required to sustain an uptrend. Therefore, a doji may be more significant after an uptrend or a long white candlestick. Even after the doji forms, a further downside is required for bearish confirmation. These may come as a gap down, long black candlestick, or decline below the long white candlestick open. After a long white candlestick and doji, traders should be on an alert that the potential evening doji star can happen. So this slide shows you doji with long legs. Long leg doji have long upper and lower shadows that are almost equal in length. These doji reflect a great amount of indecision in the market. Long leg doji indicate that prices traded well above and below the session's opening level, but closed virtually even with the open. After a whole lot of yelling and screaming, the end result showed little change from the initial opening price. The next slide shows you the Dragonfly and Gravestone Doji. Dragonfly Doji now form when the open, high, and close are equal, and the low creates a long lower shadow. The resulting candlesticks looks like a letter T with a long lower shadow and no upper shadow. Dragonfly Doji indicates that sellers dominated trading and drove prices lower during the session. By the end of the session, buyers resurfaced and pushed prices back to the opening level and the session high. The reversal implications of a Dragonfly Doji depend on previous price action and future confirmation. The long lower shadow provides evidence of buyers' pressure, but the low indicates that plenty of sellers still loom. After a long downtrend, long black candlestick or at support, a Dragonfly Doji could signal a potential bullish reversal or bottom. After a long uptrend, long white candlestick or at resistance, the long lower shadow could foreshadow a potential bearish reversal or top. Bearish or bullish confirmation is required for both situations. Gravestone Doji form when the open, low, and close are equal and the high creates a long upper shadow. The resulting candlesticks look like the upside down letter T, with a long upper shadow and no lower shadow. Gravestone Doji indicates that buyers dominated trading and drove prices higher during the session. However, by the end of the session, sellers resurfaced and pushed the prices back to the opening level and session low. Alright. The next slide shows you bullish candles. Before turning to the single and multiple candlestick patterns, there are a few general guidelines to cover. A candlestick depicts the battle between bulls buyers and bearish sellers over a given period of time. An analogy to this battle can be made between two football teams, which can also call the bulls and the bears. The bottom intersession low of the candlestick represents a touchdown for them. The bearish candlesticks. Bears are at the top, intersession high, a touchdown for bulls. The closer the close is to the high, the closer the bulls are to a touchdown. The closer the close is to the low, the closer the bears are to the touchdown. The next slide shows you reversal candle. Greg Morris, in his book, which is called Candlestick Charting Explained, notes that for a pattern to qualify as a reversal pattern, there should be a prior trend to reverse. Bullish reversals require a preceding downtrend, and bearish reversals require a prior uptrend. The direction of the trend can be determined using trend lines, moving averages, peek-through analysis, or other aspects of technical analysis. A downtrend might exist as long as the trading instrument was trading below its downtrend line, below its previous reaction high, or below a specific moving average. The length and duration will depend on individual preferences. So the next slide shows you the hammer and the hanging man patterns. The hammer and the hanging man patterns look exactly alike, but have different implications based on the preceding price history. Both have small real bodies, black or white, long lower shadows, and short or non-existent upper shadows. As with most single and double candlestick formations, the hammer and hanging man require confirmation before action. The hammer is a bullish reversal pattern that forms after a decline, in addition to a potential trend reversal. Hammers can mark bottom or support level. After a decline, hammers signal a bullish reversal. The low of the long lower shadow implies that sellers drove prices lower during the session. However, the strong finish indicates that buyers regained their footing to end the session on a strong note. While these may seem enough to act on, hammers require further bullish confirmation. The low of the hammer shows that plenty of sellers remain. Further buying pressure, and preferably on explaining volume, is needed before acting. Such confirmation could come from a gap up or long white candlestick. Hammers are similar to selling climaxes, and heavy volume can serve to reinforce the validity of the reversal. The hanging man is a bearish reversal pattern that can also mark a top or resistance level. Forming after an advance, a hanging man signals that selling pressure is starting to increase. The low of the long lower shadow confirms that sellers pushed prices lower during the session, even though the bulls regained their footing and drove prices higher by the finish. The appearance of selling pressure raises the yellow flag. As with the hammer, a hanging man requires bearish confirmation before action. Such confirmation can come as a gap down or long black candlestick on heavy volume. So inverted hammer and the shooting star. The inverted hammer and shooting star look exactly alike, but have different implications based on previous price action. Both candlesticks have small real bodies, black or white, long upper shadows, and small or non-existent lower shadows. These candlesticks mark potential trend reversal but require confirmation before action. The shooting star is a bearish reversal pattern that forms after an advance and in the star position, hence its name. The shooting star can mark a potential trend reversal or resistance level. The candlestick forms when price gaps higher on the open, advance during the session, and close well off their highs. The resultant candlestick has a long upper shadow and small black or white body. After a large advance, the upper shadow, the ability of the bears to force prices down raises the yellow flag. To indicate a substantial reversal, the upper shadow should relatively long and at least 2 times the length of the real body. Bearish confirmation is required after the shooting star and can take the form of a gap down or long black candlestick on heavy volume. The inverted hammer looks exactly like a shooting star but forms after a decline or a downtrend. Inverted hammers represent a potential trend reversal or support levels. After a decline, the long upper shadow indicates buying pressure during the session. However, the bulls were not able to sustain this buying pressure, and prices closed well off their highs to create the long upper shadow. Because of this failure, bullish confirmation is required both before action. An inverted hammer followed by a gap up or long white candlestick with heavy volume could act to bullish confirmation. So the next slide will basically several next slides would show you the bullish candlestick formations and the bearish candlestick formations. But before we start analyzing those formations, I'd like to tell you several things. First of all, what you see here on the right side after this dotted line is that this formation consists of 2 candles. In here you see, and this is only 1 candle. So if you combine the opening price of this first candle and the closing price of the second candle, as well as the high of any of those candles and the low or the highest high and the lowest low of this candle, and if you combine them, you would receive this one simple candle, which is considered to be, of course, a bullish candle. If you remember, I can scroll it a little bit up in here. So you see this is a bullish candle. It kind of looks like this one. right? Only the body is a bit smaller. So I was asked multiple times that there are a lot of bullish candlestick formations and a lot of bearish candlestick formations. And for some people, it's very hard to remember all of those formations by heart because most of them they have a Japanese names, which is hard to pronounce for some people or to remember. So that is why I would advise you to keep in mind that every bullish or bearish candlestick patterns they can be transformed into the one candle. Either they have two candles, they require two candles or three candles. It doesn't matter if you transform them in here in one candle. Most of the time, not always, but most of the time, it would result into a bullish or bearish candle. Not all the time. Just further, yeah, I will see you bullish and bearish candlestick patterns, and you would see that most of them they result into such a candle. So basically, what you need to do is to learn these bullish candlesticks, bearish candlesticks, and reversal candles. If you know these reversal candles, bearish and bullish candles, you can go ahead and try to implement your knowledge on the market. It's not really necessary to study all of those bullish and bearish candlestick formations. But anyway, I need to show you several for you to see how they look like and how the candle which they make transforms. So we'll start with a bullish Susumi. The bullish engulfing pattern, also known as bullish Susumi candle, is a second day long body candlestick that opens lower but closes higher than the prior day small body candlestick. This shows an engulf pattern by the second day's candlestick to the previous day candlestick. You can see it in here. This formation is the equivalent of a bullish key reversal in the candlestick patterns. Bullish engulfing pattern is strongly bullish if it occurs after a significant downtrend. The signal is to reverse to buy. The bullish engulfing pattern reflects a general change in the market sentiment as volumes tend to be high. Traders must be aware that it's common for a neutral period to immediately follow these formations, because the market needs to digest the large one-day activity and re-evaluate the new high market price. And the next formation is called Harami. A bullish Harami is a candlestick chart pattern in which a large candlestick is followed by a smaller candlestick whose body is located within the vertical range of the larger body. The bullish Harami is a downtrend or bearish candlestick engulfing a small bullish candlestick, giving a sign of a reversal of the downward trend. Since the bullish Harami indicates the bearish trend may be reversing, it may be a good idea to enter into a long position. Okay, so it transforms also into the bullish candle. The next formation is called the bullish candle Doji star. Bullish Doji star appears in the downward trend and warns that the trend will change. It consists of the black candlestick and the doji with a downward gap at the opening price. There is a gap between the opening price and here. So also, if you transform two of those candles into one candle, you would receive a bearish candle. However, but in here you need to know that the gap between and the absence of sharp moving downwards on this candle indicates indecision in the market. So the market has not decided whether to go down or not. All right. The next bullish candlestick formation is called Hoshi. It kind of looks like a doji star, but also this candle is not a doji, but more like a small bearish candle. At the same time, there is no gap. In this case, there was a gap here. In this case, it simply opened, the next candle opened at the same level which the previous candle closed, and then the bearish move started. Though this candle is really small comparing to the previous sharp downward trend with big bearish candles, and it also indicates the indecision of the market. Okay, another example of hoshi, but those hoshi candles, they don't have tail. In this case, there are tails. In this case, they don't. And what you see basically here is that the market moved from this point to a very sufficient support line. Then there was a small gap between the opening prices, but the price also achieved this support line, which was not broken. Even though those two candles were transformed into the bearish candle, however, this very straight support level indicates that the market can really stop, or either stop its bearish move, or it can even reverse. So the next pattern is called pricing lines. So the pricing line patterns consists of two candles, of the bearish one with long body, small tail, and the bullish one with long body, small tail. What you see here on this slide that there was a preceding bearish trend, but then a big sharp white candle appeared. You see that this is kind of a line that broke the previous upward trend, and if you combine the two of those candles, you would receive a very nice bullish reversal candle. Okay. The next one is called meeting lines. It looks kind of like the previous one, but the closing price of two candles, it coincide. So basically what you saw here is that there was a preceding bearish trend, and then there was a gap between the two candles. But instead of going downwards, the price closed the gap and basically created such a, like, those two lines, they met, and also a bullish reversal candle was formed after a combination of those two candles. Another formation is called separating lines. Basically, these is a bullish candlestick formation, and there was a bullish trend, then a black candle appeared, but even after the black candle appeared, a new bullish candle maintained the previous growth. So this is an indication of hesitation in the market, probable correction or consolidation, but after this candle was formed, you see that the market still decides that the bullish run is not yet over, and it will continue in the nearest future, and a very nice bullish candle was formed. Okay, the next pattern is called dark cloud cover candlestick formation. What you see here is basically a bearish candlestick formation. We jumped from the bullish one to a bearish one. So the dark cloud cover is a reversal candlestick pattern whereby a black candlestick opens above a white candlestick close and below its midpoint. The dark cloud cover pattern involves a large black candle forming a dark cloud over the preceding bullish trend. As with a bearish engulfing pattern, bulls push the price higher at the open, but bears take over later in the session and push the price sharply lower. The takeover of the trend is a sign that there could be a near-term bearish reversal. Okay, and if you combine two of those candles, you would receive a very nice bearish reversal candle. The next slide shows you bearish Tsusumi. The bearish engulfing pattern, also known as Susumi, is a second-day long body candlestick that opens higher but closes lower than the prior day's small body candlestick. This shows an engulfing pattern by the second-day candlestick to the previous day candlestick. This formation is the equivalent of a bearish key reversal in the candlestick chart. Bearish engulfing pattern is strongly bearish if it occurs after a significant uptrend. The signal is to reverse to selling. The bearish engulfing pattern reflects a general change in the market sentiment, and volume tends to be high. Traders may encounter a neutral period immediately following this formation because the market needs to digest the large on-day activity and reevaluate the new low price levels. Also, if you combine two of those patterns and two of those candles, you would receive a very nice bearish reversal candle. So the bearish median lines pattern. This pattern occurs during an uptrend. The first day white candlestick is followed by a black candlestick that opens sharply higher and closes at the same level as the prior session close. It is similar to the dark cloud cover pattern, however the amount this second day drops is different. The dark cloud cover second day closes below the midpoint of the first day's body, while the second day of the bearish median line closes the same as the first day. Consequently, the dark cloud cover is a more significant top reversal. Nonetheless, the bearish median line should also be respected. The occurrence of this pattern reflects as stalemate between bulls and bears. The market is in an uptrend when a strong white candlestick is formed, which further support the trend. The next day opens sharply higher, causing the bulls to feel more confident. Then the bears start counterattack, pushing prices down and leading to a close equal to or very close to the previous close. The upward is now breached. Also, if you combine those candles, you kind of receive a bearish candle in here, though you see that the opening price is lower than the closing price, which is typical for the bullish candlestick formations. But if let me scroll a little bit down, and you would see that this is more like a bearish candle in here. Oops, too far. Yes, this one. So the next candle is called pattern is called Doji Star Bearish. This pattern appears in an uptrend and warns that the trend will change. It consists of white candlestick and the doji in here with a gap up at the opening. If the doji is in the form of an umbrella, the pattern is called Bearish Dragonfly Doji. In case of an inverted umbrella, it's called Bearish Gravestone Doji. In case of in this case, right? This is a simple doji, so it's called a star doji pattern. The bearish doji star pattern, regardless of the shape of the doji, should start with a normal or long white candlestick. It must continue with a doji gapping up, like in this example. The market is in an uptrend and the strong white candlestick further confirms it. The next day opens higher with a gap up and the trading is in a small range. The day closes at the opening price, leading to the formation of a doji. Bulls were in control during the uptrend, but now a change is implied by the appearance of the doji star, which shows that the bulls and the bears are in equilibrium. The upward energy is disappearing. This is not favorable for the confirmation of a bull market. Please take a quick look at other bearish candlestick formations before we jump to live to MetaTrader 4 to analyze the live market with the help of candlestick formations. So in here you see the bearish Tasuki bar, and basically after it, the bearish preceding bearish trend, a candle opened lower, yeah, then higher. The opening price was a bit higher, but then it faced a major resistance zones and was pushed back in here. At the Kubi bar, two types of it, when the price basically opened even with the gap, so lower than the previous close, but could not maintain breaking up the previous closing price, like in this case as well. So it was the closing price of this candle is still lower than the closing price of the previous candle. So right now, let's go to MetaTrader 4 to see several examples on live market. Let me just open my trade terminal. Okay. Take some time. Just take a look where it is. All right. There it goes. All right. Let me just, all right, in here. So basically, let's scroll down to probably I don't need this support and resistance zones, which I have, because basically we would not need them. And I need a clear chart. I'm going to be opening this chart window, apply a simple template. All right, this would go. And scroll to a daily time frame. All right. This is a chart of EURUSD for the previous daily for the daily time frame. Let me just a little bit adjust something like that. And what you basically see in here, that the price is moving like in a channel, that you don't see a channel because it was down, so we don't need a channel. But let's take a look at how the market basically develops. In here, there was a bearish trend for sure, right? Like for 2 weeks or so. Then, after a significant bearish candle, what do we see? A very nice bullish candle appeared. Okay, this is a candlestick pattern, and if you combine those two of those candles, you basically would see not a doji, but more like a hammer candle, right? So if you combine this opening price in here, the closing price in here of this candle, and the very sharp long tail of it, so it's going to be a hammer. And after this hammer appeared, it goes all the way up. The same goes to here. After this black candle appeared, you combine two of those candles, you would receive something like that, and the market reverses, right? So there was a bearish trend. Then the bearish trend faced this very nice doji in here, and it's going to be uptrend. A doji in here, downward trend. In here, it's not kind of a formation, but simply market reversed. In here, if you combine two of those candles, you would also receive an inverted hammer candle, and it goes all the way down. Maybe it's not a really perfect example because you don't see directly the candles. Only in here you can see Doji, and in here you can see Doji as well. This Doji made a lower low, but closed far above the previous, even closing prices in here. So it was nice Doji. In here it was nice Doji, but in these cases it's not that obvious for you to see. So let's probably analyze another chart. Probably this one would be better. Okay. This is some painting all over. Let me just delete it quickly. All right, would be better. Even the moving averages we can delete. Let me just do it really quickly. And this we don't need as well. So just a clear chart. Okay, so let's take a look. Yeah, to analyze the chart with the help of candlestick patterns or even simple candlesticks, what you need to know is that there should be a preceding trend. If there is no trend, like in this case, a lot of dojis would appear, like multiple dojis or hammers or dragonfly dojis or whatever patterns you can find. It's not relevant. If there is no trend, it's not relevant to find the candlesticks in there. What you need to know is that basically there should be a trend in order for you to rely on those candlestick patterns. So let's take a look at the trend, all right? This is a nice trend, I think. There was a bullish trend in here, but then after a very nice bullish candle, look what appeared. This is a simple bearish candle, but if you combine two of those candles, you will receive like an inverted hammer once again. On what market starts, it starts to consolidate at first, but then reverses, like in here. Okay, if you combine two of those candles, you would receive an inverted hammer, and it would go all the way down, and the bearish trend starts. Like in here, this is a nice example. I like it. So you see that there was a bearish trend in here. Then a doji appeared, and after the doji appeared, a bullish trend started. It went all the way up until another doji appeared. Like in here, it's not even a doji, but most of the time this candle is called sword candle, or sword in British English. If you pronounce it with American accent, it's sword in here. So if the sword candle is a very nice example of how these candles work, and the market immediately start to reverse. In here, let's take a look. This is another example, or this is also a very nice one. You see, the market basically went down, started to consolidate, and then with a gap down, a doji candle appeared. After this doji candle appeared, it indicates indecision in the market. And it's not a, basically it's not a doji candle, but more like an indecision candle. So the gap was not closed, so we could assume that there is a potential for the market to reverse. But at the same time, if you take a look at the support level, it was 120. 120. It couldn't break the 120 level, and this small candle appeared after a short gap indicating indecision in the market. And the white candle went kind of suggested that it's not going to be any bearish moves in the nearest future in here. But it's not a very nice example just from the point of candlestick patterns, but more like combining candlestick patterns analysis with support and resistance zones, because if you let me highlight it, it's 120. Okay. There was a Brexit candle, but let's choose another currency pair. Alright, this would go. So once again, you see a bullish trend in here, right? Then a doji candle appeared, kind of indicating that either there is a reversal or a consolidation. And you see that consolidation started. Then we see a bullish candle, right? So which suggests that the bullish trend is not yet over, but after it, a very nice bearish candle appeared. If you combine those two candles, you will receive a bearish candle, and then the bearish move starts. Okay. Like in here, you can see Doji as well. So there was a bullish trend for some time. Then indecision, Doji, we go down. In here, a small bullish retracement, hammer, inverted hammer, and we go down. In here, it's also a good example of inverted hammer and how it works. Bullish trend for 2 weeks, inverted hammer goes down. Okay, let's take a look at some probably commodity like gold. We can do. Oops. All right. Let's go to more recent chart. Like what you see on the gold chart is basically this is the recent chart. There was a bullish trend. This bullish trend was faced with a very nice doji in here. Then the consolidation, a little bit bearish move, but more like consolidation started. Then there was a very nice, sharp, good bullish move in here. And then inverted hammer appeared on the top. You see that also it almost touched the resistance level of 150, but almost. Sometimes it doesn't count as people say, but anyway, it appeared on the top of the market, and immediately after the bearish move started, the bearish move continued, right, until another candle appeared in here. And then after that, after this candle, consolidation started. Okay, two more recent. Let's just scroll it. Now, like in here, good example. It was going down all the way down, and in here you see almost a doji, it's almost doji, appeared on the market lowest low, and then a slight bullish retracement and a consolidation started. Okay, in here as well you see a very nice bullish move, inverted hammer, and bearish retracement. Now let's go to probably something more interesting. Let's go to a cross rate. British pound, Japanese yen. You see bullish move, doji on top of the bullish move, and bearish retracement. It kind of looks like a USD GPY chart, which we have analyzed. A gap at resistance level, substantial, and then the bullish move. In here, you see the bearish move, bullish reversal candle, and it goes all the way up. Let's jump to the more recent one. Now in here, basically, it's hard to tell because it's not a really substantial trend in here. I can't see the trend here. So basically you would see a lot of dojis and inverted hammers and the other candlestick patterns, but you cannot say that the trend is going to reverse or do something because there is no substantial trend. It was a trend in here, Doji appeared, and the consolidation started. But before, you see that the bearish move was stopped by a hammer candle, and then the bullish run was terminated by the Doji candle, and so on. So basically, these give you an impression that it works like in here as well, the bullish run. Then you see that there was Doji, and then the retracement started. All right, I guess that's enough examples, at least to show you how it works. And we have more like 5-10 minutes for your questions. So if you have any questions, feel free to write those questions in the question section, and I'll be happy to answer it. All right, the first question is, do I use the candlesticks for my own analysis? Of course, I would tell you that I do use the candlestick patterns for my own analysis, and I do trade with the help of candlestick patterns, as I showed you in several examples in the live market, that is basically working and working very nice. Not all the time, but most of the time, if you choose high enough time frames, like daily time frames, hourly time frame, 4-hour time frames, it's basically a very useful instrument to analyze market and to do additional confirmations that the market is going to reverse or consolidate. And yes, I do use the candlesticks in my own analysis. Is it possible to trade only with the candlestick patterns without any indicators? One person is asking. So I would say that there are different types of traders, and there are technical traders, fundamental traders, and probably there are some traders who trade only with the help of candlestick patterns. I'm not such type of trader. I do prefer to use different instruments which I have in my arsenal. So, but if you find that you can basically trade only with the help of candlesticks and a clear chart, like you see in here, clear chart and only candlestick patterns, so you can go ahead and try to do that. But at least I would use some confirmations like the moving averages, which we had on this slide, or the basic support resistance zones as additional confirmation of where the market would go. I would use those. But if you feel comfortable that trading only with candlesticks can make the best profit for you, yeah, why not? You can go ahead and try to do that. Yes, it's hard. People saying that it's very hard to remember all of those candlestick patterns. I can scroll a little bit above, but I told you that there is kind of a rule that if you combine those candlestick patterns, like in here, you would receive one candle, which would suggest you where the market would go, and basically remembering all of those patterns by heart. Those are not just every pattern that there is there on the market. There are much more patterns. I just use several examples for you to show. But if you want to trade with the candlestick patterns, probably you should learn more of it. But what I do use in my own trading, I mostly remember the bullish candles, the bearish candles, and the reversal candles. And what you need to remember as well is that there should be a preceding trend prior to applying the candlestick patterns. As you know, let's say you cannot use the candlestick analysis when there is no trend because it's irrelevant. When there is no trend, the candlesticks such as Dojis would appear every single day. Or probably, if you use a 4-hour chart, it would definitely appear every single day. But when there is a trend, it's quite applicable to use the candlestick patterns. So some person is asking which of those patterns are more reliable and which of those patterns are less reliable. I would say that I cannot rank it like more reliable pattern or less reliable pattern, but I can tell you for sure that the sharper the trend is, the better it would be to use those. If there is a strong preceding trend and the candle appears, there is a very high probability that the trend would reverse. If there is no preceding trend, so probably this candle would not have such an effect as you desire, or at least if there was, let's say, not sharp trend but a slow trend, it would not be that effective if you want. So let me scroll down. We can basically say that there was a trend, right? On, let's see, let me just scroll it a little bit in here. So there was a trend in here, and the candle appeared, and the market reversed. But can we say that this trend was very sharp and very high? No, because it basically took the currency pair to go 350 pips, and it took the pair like how many? 11 days. 11 days, 2 weeks to go 350 pips. This is considered to be a trend, and I would not argue that it wasn't trend. It was a trend, but at the same time, I cannot say that the trend was very sharp, right? So this trend is much sharper. The angle is much bigger. So if there is a sharp trend and then the candle appeared, there is a very high probability that the trend would reverse. If the trend is not really sharp, so probably the probability is much less. In this case, there is absolutely no trend. The market is going ups and down, ups and down, ups and down. So in this case, using the candlestick analysis is irrelevant. Okay, so but I cannot tell you like there is a clear ranking that this pattern, let's say the inverted hammer is working better than the usual hammer, or bullish Tsusumi is working better than Harami. There is no such thing. Probably if you do your own statistics, and if according to your statistics using bullish Tsusumi has a better probability for your currency pair or commodity you are trading, yeah, it would be good for you. So yeah, we have so far so good. We have a webinar regarding the trading journal, statistics, trading psychology, and money management in 2 weeks, and you are more than welcome to join this webinar. And I'm going to be telling more things about the trading psychology and keeping your trading journal and your statistics. And these statistics would probably help you to create a more profitable trading system. But let's say I don't have such ranking for my trading system. All right, any other questions? If you have any other questions, feel free to ask. I'm here to help you. All right, people are saying thank you. Some of you, it's been more than 1 hour already, so we need to finalize our webinar. Once again, I'd like to thank you for visiting the webinar. I'd like to remind you that we have 2 more educational webinars. Next Thursday, we have a webinar regarding support and resistance zones and trend line. And in 2 weeks, as I said already, we have a webinar regarding the trading psychology, money management, and trading statistics. So you're more than welcome to join this webinar in 2 weeks. The same time, it's always the same time. And I'd also like to remind you that we have a live market analysis webinars on Monday, also same time. You are more than welcome to join those webinars. In there, I analyze pretty much every major currency pair on Forex and some cross rates. And if you have any suggestions of which currency pair or commodity you want to be analyzed to, feel free to join the live analysis webinar on Monday and ask me to analyze any currency pair in a live market. Once again, thank you very much. You have a profitable week ahead and a great weekend. I'd like to thank you one more time for visiting this webinar, and I hope that you have enjoyed it. Thank you very much, and goodbye.